Hello, everyone. Welcome back. Thank you, as always, for listening. And this week, watching, we have another fellow retirement planner, someone in the business joining me, none other than Cody Garrett from Measure Twice Money. Hello, Cody.
Hey there, Andy.
I'm thankful you're here. I've been looking forward to this. I'm sure you and I have chatted a lot in the last few years, and I know we have very similar philosophies and views about a lot of this stuff. So this should be an exciting one. Those who don't know Cody, if you are active in the Facebook group, you definitely know Cody. He's been one of the moderators since basically day one, I think. Very active contributor, very thankful for him. And he's also recently co-authored the book, which you heard me talk about before, Tax Planning to and Through Early Retirement, along with Sean Mullaney. Fantastic book. For those of you who have not yet picked it up, I highly recommend doing so, not because Cody's here or because I get any money from it. I just truly believe it is that good of a book about tax planning as it relates to retirement. What's up, Cody? How's all with you?
Not much. It's we're recording this in the new year. There's a lot of concerns. Well, I guess there's always concerns around tax and retirement planning, but my goal is to just like you, just provide really objective education around what you can do and what you can plan around. And we'll today talk about some of the hot topics that a lot of them. There's a lot of fear-based marketing out there, whether it's selling services, products, etc. And we'd like to break down the fear by just really providing education around what's within your control moving into 2026. So yeah, it's exciting. I just got off the call with a client today who has to be very careful about their income in 2026, trying to get those premium tax credits, those health insurance subsidies before Medicare. She's actually turning 65 this year, so she's so thankful. It's so funny when people are so thankful to get to switch to Medicare versus having to deal with early retirement insurance. But it's been a good year. It's going to be a lot of planning. I'm a little hesitant about people in 2027 thinking about all the things they could have done differently this year because of all the new OBBB. I always say whether you call it the one big beautiful bill or the one big ugly bill, like there's probably something in there that applies to you. So I think that'll probably cover some of the topics today.
Okay. And before we get into it, that was a good preface about Affordable Care Act, premium tax credits, managing income, et cetera. I do have a question for you.
Sure.
What is the difference between a well-dressed person on a unicycle and a poorly dressed person on a bicycle?
Oh man, I don't know this one.
Attire.
Attire.
Yeah, huh?
I love it. I love it.
Yeah. And I heard that from my 16-year-old yesterday. I think she found it on like TikTok or something. It's like, man, that's a great joke.
Yeah. You've probably heard my favorite one, right? The what do you call a nosy pepper?
I don't know if I have.
Jalapeno business.
Okay. I like it. And apologies, I don't know if you all listening heard it, but there was cars giving prolonged honks outside my office window here. There must be someone double parked in the street.
They don't like the dad jokes, yeah.
No, that must be it. Yeah, they're not fans of the dad jokes. All right, so let's jump right into it. So this is a hot topics. Cody and I will discuss a handful of things we think are either current events and relevant or just sort of consistently questions, comments, concerns that we hear from folks we work with or folks in and around the retirement planning community, like the Facebook group or questions in the podcast, et cetera. The first one you already sort of touched on, Cody, the Affordable Care Act, aka Obamacare, and the concept of premium tax credits, which are basically just income-based subsidies you can get to reduce the net amount of premium you have to pay each month for qualifying policies. And then eventually, that stops when you get to Medicare. I don't have to worry about being on Affordable Care Act. But what are your thoughts? What have you seen, especially now this year? So we are back to the old premium tax credit rules, which aren't nearly as generous as they were the last few years under the enhanced rules. Where do you want to go with that?
Yeah, so this comes down to what's called the federal poverty level. So this is based on, I'm sure you talked about MAGI, M-A-G-I lots of times. There's different definitions of MAGI. In this example, just to let you know, one thing to think about in terms of the definition for this version of household income for the premium tax credit, you also have to include the non-taxable portion of Social Security. This doesn't apply that much because typically, at least the clients I serve as a financial planner, they're not claiming Social Security before 65. But just keep in mind, if you're in that place of pre 65, if you are getting premium tax credits, it's also going to pull in the non-taxable portion of the Social Security. So the big thing that's happened is that effectively we've been thinking this way of 100% to 400% of the federal poverty level. You become eligible for these premium tax credits, which they call them like advanced credits. So rather than, you having to prepay or like pay every month to your health insurance provider and then having to be reimbursed. The government effectively makes that payment for you as an advance credit. But what happens is if your income falls above or below what you anticipated your household income to be. By the way, when you sign up during open enrollment or special enrollment with the ACA, you tell them, hey, this is what I expect my household income to be. It'll say, here's your allowable advance credit. How much would you like to use each month, in terms of them paying the provider instead of you? Mm-hmm. But it all comes out in a wash. It's not like you can just say, oh, I'm going to get maximum credits. And then you're like, it'll all work out. When you end up filing your return the following spring, for example, you're going to potentially have to pay back some excess credits if excess advance credits if your household income is either higher within that range than you expected, or if you fall below that range. It's kind of a gray area we probably won't cover today. But the big concern in 2026 and beyond is if your income as a family exceeds 400% of the federal poverty level, it is a cliff. The cliff returns in 2026, that it's not gradually phased out over 400%. It goes over $1 and you could potentially lose. I did one example today in my calculator. A married couple in 2026, they're both 64 years old, perfectly in Texas, and effectively, if they go $1 over, they will be out $24,000 worth of premium tax credits. So if they had anticipated, one example here, I know that it's always fun to do live stuff like this on a podcast, but this example with the married couple age 64, they're covered by a marketplace plan. Their household income they anticipated would be $84,600 for the year. When they filed their taxes, they found out it was actually $84,601, and they had to pay back $24,912 of the advance credits that they'd received throughout the year. So this is not to say like be scared, but there's a lot of planning that needs to be done, especially for those who are kind of in that top of the, maybe in like the 300 to 400% federal poverty level. There are some great calculators online, like KFF. I'm not affiliated, but kff.org, I believe, has a good calculator like per state. And then certainly hire a professional if you want detailed analysis. But you can effectively think of this as if you end up exceeding the cliff, going over the cliff, that sounds bad, going over the cliff, then a general rule of thumb is it's about a $10,000 loss going over that cliff per person covered by the health insurance plan. So this can be a significant planning consideration. And also think about this, a premium tax credit, right? A credit is different from the deduction. So this credit is either a dollar for dollar reduction of your premiums that you pay, or if you have to pay them back, it's a dollar for dollar reduction in your refund or that you'll have to pay back.
Yeah. So I'm just curious, when you said the average sort of per person cost of going $1 over the cliff is 10 grand. Now I know by state, there's different policies available at different prices and different second lowest cost silver, whatever. Just curious, where did that 10,000 thing come from? Was that just based on the example you did, or that was some more comprehensive, like statewide analysis?
Yeah. So on average, so I typically work with people who are retiring between age 50 and 64, kind of like the 15 years before Medicare. And lots of states have their own rules. I would also say that we talked about the 400% as the cliff, but there's also like kind of the starting to get into eligibility is either 100% or 138% of federal poverty level, 100% for about 10 states, and 138% for the other 40. There's something called Medicaid expansion. So look at that if you're on the lower end of the income. But I'll just say, like, by doing dozens of these analyses, like this year, at the end of last year, I'm seeing that ages 50 to 64, it does get more expensive as you age. And it's also based on location and household size, right? So if you're household of 1, 2, 3, et cetera, also your location based on zip code. So yeah, you definitely want to do your own analysis. And that $10,000 per adult is kind of like a rule of thumb I'm telling people. But of course, if you log in, it's not going to be exactly $10,000 loss. Just a kind of a general rule of thumb for this planning.
And this is, you use the word cliff, which I think is great and very applicable. This is one of the areas of the tax code and tax planning that's really hard, where the whole idea of the cliff is you go one step, 1 cent, one little bit over it, like it's gone, or you're in the whole next bracket or wherever it may be. Right. So like normal tax rates, there's the 10, the 12, the 22, the 24, 32, whatever. if you go $1 over that limit, it's not a cliff, just that incremental dollars taxed at the new rate, for example.
Right.
But then there's cliffs like this. You go $1 over 4 times federal poverty level, your gross income, you went from eligible for something to eligible for 0 credits. And the IRMA is another cliff where there's 4 or 5 bands where if your income is $1 into the next band, you jump up to the next IRMA. There's not this gradual phasing into higher Medicare premiums. So definitely tricky. And this year, back in play, just to recap, there's been a lot of like uproar about healthcare becoming more expensive, which is true compared to what it was. But we're just going back to rule. I'm not saying this is right or wrong. We're going back to ACA rules that were in place pre-2020, pre-2021, I want to say, when they were temporarily enhanced. So there's more subsidies given to more people were eligible, et cetera. Those enhancements went away effective January 1st, 2026. One of those enhancements was the getting rid of the cliff and making this gradual phase out. As your income went above 4 times federal poverty level, you slowly phased out from getting credits. Now, 2026, we're going back to old ACA rules. You go $1 over, boom, done. You're not eligible for any credits, like full stop.
Right.
So it makes planning much more difficult. You need to leave much more buffer in your projections and stuff, especially the more variable income might be. Like if you have mutual funds and brokerage accounts that pay capital gain distributions, those are a big wild card each year. Interest in bank accounts, surprise, gambling winnings or other things that get that get reported or that you're supposed to report regardless, I should say.
Yeah. Well, and I also want to add to that. So a lot of people are saying, okay, well, like, oh my gosh, like this is a big deal, right? Because most people who are thinking about this, like they're a part of this. So
yeah,
not only does this apply to early retirees, which, we talk to a lot, but also self-employed. So, I'm self-employed. Like, I mean, I guess it's a good problem to have to like not get any premium tax credits because, my business is doing pretty well. But thinking about, okay, this applies to a lot of us who listen to podcasts like this, but did you know that only about 10% of Americans are covered by the ACA, and of them, about 80% of those pay less than $25 a month for their health insurance after the premium tax credit. So there's a lot of uproar about these, like, the cliff coming back, but it's a very like, relative small minority of families that are affected. But again, with all that said, even though it's a small percentage, that's still like, tens of thousands, hundreds of thousands
Correct.
of families are going to be impacted. And I also think that the impact won't be felt until tax filing 2027. And maybe just put on your calendar, probably March of 2027, April of 2027, there's gonna be a lot of articles coming out about families who are like thought that they were getting $20,000 in premium tax credits, but now they have to pay that back to the government. So I think it should be talked about today, but I think it will be talked about kind of after the fact in 2027, unfortunately.
Meaning a lot of people probably aren't aware of the change with the cliff coming back and didn't do the planning necessary to leave a buffer, et cetera, and get a nasty surprise at tax return time.
Yeah, that's right. And the ones who get a nasty surprise are probably already maybe, on average, financially unaware in general, right?
Yeah.
And may have to kind of figure out, okay, how do I pay that tax bill? Do I have to get on a payment plan or pay with a credit card and, kind of, create a downward spiral. I'm not trying to put fear on people, but
right.
I think a lot of people who don't listen to these types of podcasts will be, they don't know what this cliff was before or now that it's coming back.
Yeah. And I'll just say, in my practice, this has made it, I don't say easier, but for some clients where they're not yet 65, we were previously managing income to get them some amount of ACA credits. Even at incomes of $100,000, $150,000 gross income, they're still getting pretty chunky credits in many cases. Now it's like, we're not even going to try because 4 times federal poverty is like $80-ish thousand, like you meant, for a family of 2 living in the lower 48. Alaska and Hawaii have slightly higher limits, but so now it's like we're not even going to try. And some clients, it's a great problem to have, but they have so much dividend or interest income and/or large enough IRA balances. It's like keeping your income below 80 grand isn't going to help you long term at this point. So
yeah, that's right.
Such is my guess, educated guess.
And I think the irony is that a lot of traditional retirees, which I call 65 and up, a lot of them are worried and complaining about IRMA, like the surcharges for Medicare, original Medicare, or part B and D, mostly people are talking about. But then, the irony there is that pre-retirees, the early retirees who are trying to manage for this stuff, they're so glad when they get to 65, mostly because of simplicity, actually, because they're like, thankfully, I don't have to try to control every little dollar I take out of every account. And also 65 opens up the golden years of, there's a lot of Roth conversion opportunities. There's still time to delay Social Security, right? There's, RMDs haven't started. So there's, I think 65 to 69, like those are like, those would be like the perfect, what we call the golden years. With all that said, IRMA is also a big consideration. And the only thing I'll mention here is IRMA does feel like a big deal, but thankfully it's recalculated annually based on the income from 2 years prior. And also a little fact that nobody talks about when it comes to fear-based marketing is that IRMA, so those additional premiums you pay, the surcharges for Medicare, they will never exceed, based on the current rates, they don't exceed more than 3% of a household's income, right, based on 2 years prior. So a lot of people are worried about IRMA. I will say that, like, yes, it might look like a big dollar amount, but relative to your other budget, your other expenses in your budget, like 3% of your budget, like, most people aren't complaining about 3% of other parts of their budget, but they will in terms of something related to, healthcare and the government surcharges.
Right. Yeah. Just to put IRMA in context, the base Part B premium this year is $205 or something like that, a little over $200. If you are in the first band of IRMA, which lets you as a married couple, gross income up to like, it's probably going to be all said and done, like 280 grand or close to it for this year,
Right.
Or half of that if you're single. It only adds roughly $100 a month to your Part B and Part D if you got it. So that's
Pretty
still
wealthy families on average are
exactly. Pretty fairly well-to-do families, generally speaking, now paying 300-ish a month for Medicare as opposed to 200-ish. Like that's still quite good for what's good coverage, right? So putting it in context, IRMA isn't nearly as bad as a lot of people think. Now, not to say it doesn't sting when you're high up the IRMA bracket, paying $500 a month extra, but still, like you said, from a percent of income perspective, it's relatively modest.
Yeah. And just the last thing on that is going from 64 to 65, if you're like ACA coverage, going to Medicare plus, supplemental plan, let's say Plan G is just an example, not advice, that you might be going from paying, without the premium tax credit, over $1,000 a month per person, right? And then you go into Medicare with like the best supplemental plan you might be able to get, and it's going to be a lot less than that. So, even with IRMA. So a lot of people are just so glad to just go over that, go over the cliff and away over to 65 and hang out with the new crew.
Agreed. I don't know any clients who've said, man, I wish I didn't have to go on Medicare, regardless what their insurance was prior. It's like, other than the bureaucracy sometimes they're dealing with the government, outside of that, the coverage itself is good policy from what I gather. Okay. Let us march on. The next talking point here is one that consistently comes up in my mind and I have to think about when making projections and recommendations to folks of what I think they should do from a tax planning perspective. Doing Roth conversions versus tax gain harvesting. If you have a regular brokerage account and positions at a gain that you could, sell, realize the gain, depending what bracket you're in. Maybe you pay 0 federal tax on that gain. Maybe you pay 15, maybe you pay 20. Maybe there's additional 3.8% net investment income tax. But this is often at odds with, well, I want to do Roth conversions, but every dollar I convert from my IRA to my Roth crowds out some of my long-term capital gain tax bracket where I can harvest gains. How do you think about this and approach this with people?
So I think about the two sides of how income is taxed. There's ordinary income. So that would be included of Roth conversion, for example, or like a traditional IRA distribution, normal distribution, or pension income, net real estate, net business, et cetera. Then there's the other side, which is the long-term capital gains income. This is the qualified dividends and those realized long-term capital gains, which might apply for the 0% bracket, which is called tax gain harvesting. So I have to separate those two first. And if you're in early retirement, right, if you're pre-60, actually really pre-59 and a half, really early retirement, you might have to consider, right, if you're doing a Roth conversion that you plan to gain access to later, you might have to consider the 5-year rule on the taxable Roth conversions without being able to take out without the 10% penalty, beyond the scope of today's conversation. But let's assume for a minute that you're over 59 and a half. I think, when you're looking at both sides, you might think, well, there's not a 0% bracket for ordinary income, right? So it starts at the 10%, then the 12, 22. But in reality, there's actually a massive 0%, what I call effective tax rate for ordinary income, which would be your standard deduction, your additional standard deduction, 65 and 65 up. Also, this new senior deduction up to $6,000 per spouse over 65, or if you're individual, just $6,000 for the senior deduction. There's income phase outs, but ultimately, like an example here in 2026, if there's a married couple over 65, their ordinary income could be offset by all these deductions adding up to $45,850, right? And you say, okay, well, if I'm going to get deductions that I can use for either side, ordinary or long-term capital gains, the like unfavorable income taxation is on the ordinary side. So typically, I would want to fill up all those significant deductions with ordinary income, and potentially that could be with Roth conversions. So I think, sometimes I hear, never waste a low tax bracket, like, never waste a 0% effective tax bracket. So I typically like to fill up ordinary income with, if I have room, assuming I have room in there, outside of the interest and non-qualified dividends and other ordinary income, I might fill up the 0% deductions with Roth conversions and then step back and reset and say, okay, now do I want to move to doing more conversions, maybe within the 10%, 12%, or do I do tax gain harvesting, which is 0%? Effectively, kind of, if you look at them side by side, the 10 and 12% bracket on the ordinary side is equivalent to the 0% on the long-term capital gain side. So that's the big decision is, hey, which one do I do? I'll just step back and say, the number one thought is prioritize diversification. So I think if J.L. Collins, who wrote the book Simple Path to Wealth, he calls it the cats and dogs of the portfolio. Like, if you look at your taxable brokerage account and you see appreciated securities that you wish you didn't own, or another way to say that is, if this were all in cash, would you buy that security again? A lot of people might have inherited money that has maybe even got a step up in basis, but now has grown since then. Or maybe they own some, they have a significant amount of equity compensation that they've held long-term, those long-term capital gains rates. I would typically prioritize diversifying your portfolio, especially if you have significant one holding holds the significant part of your wealth. But that really requires you to step back and understand your holistic, comprehensive financial plan to begin with. So I'd say, the plan first, which includes understanding diversification and just basic asset allocation of, hey, like, should I be planning for more fixed income in my portfolio depending on my future income sources? So what are your thoughts, Andy, on kind of filling up those brackets?
I think generally the same. So just to sort of like rephrase what you said, if you have, everyone has a standard deduction at a minimum. If you're 65 or older, you have the additional 65 deduction and the new, which is around for a few years, up to $6,000 per person, extra senior bonus, whatever you want to call it, or there's income limits around that. But if you have zero other income from the year, you have complete control where your income comes from. All else equal, it would be better to use your deductions to wipe away and erase the taxable income from ordinary income like Roth conversions that'll be taxed at 10 or 12% otherwise, as opposed to wiping away the income from realizing long-term capital gains, which would already be taxed at zero because it has a 0% tax bracket for it. So from a pure tax perspective, yes, that's the mathematically right answer. But it's not that simple. Like you said, you have to look at the bigger picture of your portfolio. If you have really concentrated holdings in your brokerage account that you don't want, that are like dangerously concentrated, super high risk, maybe you want to prioritize trimming that down. And a tax efficient way to do that could be, if you're in the 0% long-term gains tax bracket, fill that up with reducing some of that position as opposed to doing Roth conversions. That's the reason why you want to do that. Another thought is just overall diversification across the taxability of your different buckets of money. If you already have pretty large Roth, like let's say you were aggressive at conversions in prior years, your IRA is already fairly small. Not a lot of reason to like get super aggressive at converting that. You already have a lot of Roth, and then you have this brokerage account with some pretty big positions with large unrealized gains. Then I'd lean towards, let's do the 0% tax bracket again to, reduce that. So another great example of like, it depends, there isn't a perfect answer. Depending on the situation and assumptions you want to make, option A could be better, option B could be better. But as long as you know the factors hybrid, involved, a hybrid of the two. I also think some people just sort of like mentally, it feels like a little cool win if you can take advantage of the 0% tax bracket, sell something that you bought 10 years ago, sell it, realize a gain, immediately rebuy it. You just wiped away some of that gain at 0% federal tax, at least. State could be different. Yeah. That little sort of moral victory could be worth it, even if
I won the game. Yeah.
Exactly. Yeah. And if you're worried about this level of planning, like this is
Right, yeah.
such a higher level optimization. It really doesn't matter what you do, frankly. Like
Yeah.
as long as your big picture is good, your allocation's right, you saved enough relative to your expenses, blah blah blah. This is just fine tuning hypothetical
Right.
optimization stuff.
Well,
That's really there
I do,
to nerd out
I
on.
Yeah, I do have one. Here's one interesting twist, though. I've seen a lot of early retirees make this mistake. So we talked about premium tax credits with the ACA. Let's say somebody's 64 years old, right? And they're doing tax gain harvesting. They're like, oh, I'm going to take advantage of the 0% long-term capital gains bracket. Well, guess what? Even if a long-term capital gain or a qualified dividend is taxed federally at 0%, that income is still included in your MAGI,
Yes.
your
Yeah.
modified adjusted gross income. So I've seen people who say, I'm going to do tax gain harvesting and get it all at 0%. And then that just knocked them out above the 4%, 400% cliff now. And they're like, okay, even though it was like a free tax gain harvest, I'm now paying back again, ten,
You
twenty
just
thousand
lost
dollars in
out.
tax
Yeah.
credits.
Thousands
So
of dollars of credits.
that's a pretty high effective tax rate. By the way, if you're within the range, if you're within the 100% to 400%, every dollar you tax gain harvest within that, you can think of that effectively as like a 12 to 18% tax rate in terms of reduction of premium tax
Giving
credits.
up some tax credits. Yeah. That
Right.
makes
So
sense.
even though it's 0%, just know that just because it's 0% on, the income tax doesn't mean it's 0% for other benefits.
Because that's still included in your gross income that flows through to all the different
Right.
definitions of
That's
Maggie
right.
or Magi that, yeah. Okay.
So you call it Maggie and I
Excellent
call it
point.
Magi, right? I
Yeah,
love
I
it.
just decided at one point along the way, I'm calling it Maggie and sticking to it. I know there's no
Yeah, yeah.
universally accepted or right answer for how
Well,
you're supposed to pronounce it, but
Irma sound like two old nice ladies that hang out together, right? Irma and Maggie.
yes, yeah. I guess German sounding
Yeah.
names, Maggie and Irma. I don't know. Okay, let us move on here. Next topic, paying taxes in retirement. I know this can easily be an hours long
Yeah.
episode in and of
Sure.
itself, but
Yeah.
what kind of things you want to share with the crowd on this?
Yeah. So there's kind of there are three ways to do this. I guess well, two ways, which is the safe harbor rules, which I'm sure you talk about as well in videos, is that the idea of paying the lesser of 90% of the current year's tax liability or 100% slash 110% of last year's, depending on how high your income was last year of your prior tax liability. Most clients I work with, we go ahead and do the 90%. Sorry, we go ahead and do the 100 or 110% of last year's, unless we know we're going to have like much, like lower income this year.
Mhm.
We're able to kind of estimate the 90%. So with all that said, there are really two ways that people pay taxes in retirement. One is by making estimated tax payments. People call them quarterly, but they're not actually equal quarters. They're, called tax periods. They're not equally every 3 months. But my favorite way actually to pay taxes in retirement is through withholding. If you're taking money out of a retirement account, so especially like let's say you have an inherited traditional IRA that you're taking RMDs out of, that's a great place to go ahead and withhold maybe a portion or even sometimes 99%, for example, to cover the taxes, not just on that income, but maybe all your income. One great thing about withholding from a 1099 source, like a traditional IRA distribution, is that the IRS deems it as being paid equally throughout the year. So one of the cool things is, let's say somebody has like all this income from capital gains and Roth conversions that they withheld 0% on. Then they get to like the end of December, they finally take their RMD or something, or they finally take an inherited IRA distribution, and they withhold maybe 99% to cover all their taxes for the entire year. And what's nice about taking that directly withholding from those distributions is that you don't have to worry about quarterly tax payments. You don't have to worry about, hey, I paid all my taxes in Q4. Now I have to fill out Form 2210 to try to annualize it. Like, it's just a really nice, easy way. With that said, of course, like, you won't necessarily have that option, right? Or that might not be the best solution to start taking money out of those retirement accounts. So, but yeah, what are your thoughts on kind of best order of operations for paying taxes?
I always lean towards withholdings wherever possible instead of
Mm.
estimated payments for the reasons you mentioned, that you don't have to worry about the timing element. If your total tax obligation for the year is 100 grand and you do it all through withholdings, you can do a single IRA distribution, have 100% of it withheld in December.
Right.
You're cool. The IRS will pretend like that was paid 25, 25, 25, 25 throughout the quarters.
Yeah.
Versus if you make estimated payments, you do need to plan ahead. You do have to actually pay 25 grand by each of the tax period quarterly end dates, deadlines. If you don't, then there could be underpayment penalties for having not paid enough tax earlier in the year when you should have, and the clock starts running on interest, which I think is currently 7%. I could be wrong. Maybe it's 6 now. So it's not cheap. So that's the good news. Withholding's much easier. You don't have to worry about the timing. The downside is there's only certain sources of income you can withhold from: wages.
And it's taxable to be like the distribution, even if it's withheld, it's still taxable.
Correct, with an IRA. That's going to be the other thing I was going to mention. But the first limitation is only certain sources of income you can withhold: wages, Social Security, pension, annuity income, IRA distributions, gambling winnings, and maybe something else. Insurance, life insurance proceeds, I think.
Yeah.
If you don't have any of those sources of income, like what are you going to do? Or if you're under 59 and a half, you can't distribute from your IRA to make withholdings without being hit with a 10% penalty. If you have wages, for example, maybe there's not enough wages left in the year for you to tweak your withholdings to withhold enough to cover you for the rest of the year if you're short. If you're in retirement or you're 59 and a half or older, let's say, and you have penalty-free access to your IRAs, that's a great trick where you can take an IRA distribution, withhold all of it for taxes, that'll cover you. Like you said, though, that withholding is a distribution in and of itself. So you have to account for that much in your gross income in the first place to make sure you're withholding enough to cover not just the rest of your income, but that distribution you're taking. I really like that. Now on Roth conversions, this is a common question. How should I pay tax on conversions?
Depends on what age you are, right?
Yeah, it depends on what age. Let's assume you're over 59 and a half, so you have penalty-free access to your IRA. The mathematically optimized answer, and I forget the specifics why, but someone did this detailed explanation once and it made sense at the time. It'd be better from an optimized perspective to pay taxes not from the IRA itself, but to make withholdings from bank account money, brokerage account money, and convert every dollar that leaves your IRA, convert to your Roth, as opposed to pulling some off from withholdings.
That's right.
Again, that's another optimization tool. It's not going to make or break you. You have to weigh that return on hassle, which is a phrase you came up, or that I heard from you that I absolutely love. Is it worth having to do that and make the mess around with the quarterly payments, whatever, or just withhold it straight away from your IRA? I lean towards the latter because it's simpler, easier, especially with people I work with. Since I'm their advisor, I can do all this for them. I can do the projections, I can do the withholdings, I can do the distributions, as opposed to them having to mess around and make the changes and update their withholding percentages, et cetera.
Right.
So I lean towards that. But again, just the optimized mathematic answer is you should pay taxes ideally from outside the IRA.
And last note on that. I think a lot of people say, hey, like I don't have taxable brokerage or checking savings to be able to pay taxes outside of the conversion. Does a conversion still make sense? And I'll say it depends. But I've actually seen plenty of examples where it still makes sense long-term tax planning wise to do a Roth conversion, even if you withhold the taxes. So don't, just don't assume that if you have to withhold the taxes from the conversion to do a conversion, like that still might be beneficial. Just know that, you need to, measure twice before making that decision.
Yeah. My other thought just came to mind. Going back to, yes, I agree. Mathematically, it makes the optimized answer is pay taxes out of non-qualified assets like bank or brokerage account money if you have it. If you do have it, if you've got $1 million sitting around in a money market fund in your brokerage account, sure, go ahead and use that to make estimated payments on your conversions. If you only have, not only, but you have $50,000 in cash, let's say, and you're doing a $200,000 conversion, you might have enough cash in your bank or brokerage account to pay taxes on that 200 grand conversion, but now you're low on cash. Next year, how are you going to replenish cash? You're going to have to pull it out of your IRA anyway. Right. Well, yeah, right. You're going to be pulling it out of your Roth anyway, which is counterproductive to the conversion you just did, assuming you pull it out quickly thereafter. Or you're going to need to pull money from your IRA to top up your cash. So if you're taking money out of your IRA anyway, just skip the middle step and just use that IRA in the first place to do
normal
a distribution.
Yeah.
Exactly. Withhold taxes right from there. So
I love it. I love it.
Another, since we ended the paying taxes in retirement segment on conversions, and another bullet you brought up that I'm curious to hear your thoughts on, rushing into Roth conversions. You say this one is hot, exclamation point. What do you mean by that?
Yeah, I think we're in the season of kind of every year there's something that's hot in personal finance. Like I remember, a few years ago is like the I bonds. Everybody was trying to get their 9% or whatever on their I bonds. Tip sliders have been big like lately. What are some other big like hot topics, Andy? Or like the monkey pictures a few years ago, like those.
Monkey picture?
People like kind of connected to the crypto thing. We had like people buying the EFTs or whatever
Oh
they're called.
yeah. NFTs, non-fungible
NFTs.
tokens.
Yeah, there we go. Yeah.
Yeah, I bonds were definitely had their run when you were getting 9% guaranteed interest, granted only for
Mhm.
6 months, and then it reset. But still, that was something. What's it? Tips. I don't want to say come in and out of fashion, but certain people lean more towards tips. They fully buy into the concept of tips, Treasury inflation protected securities.
Hmm.
Um, Others don't. Now, what am I seeing now? No major changes now. I think the what the industry is pushing, what Wall Street's pushing
Buffered
is,
ETFs and things like that. And
yeah, buffered products, index products, private product like private credit,
private credit. Yeah.
alternatives, access to private equity funds on a sort of a
High,
retail
high
basis.
expense ratios all around.
Yep.
Yeah.
Higher expense ratio, lower liquidity, lower access to your money. In
Hmm.
theory, it's supposed to be non-correlated or less correlated to traditional assets. In theory,
Hmm.
it can provide better long-term growth than traditional stocks and bonds. That's all in theory. Is the
Yeah.
juice worth the squeeze? Vast majority of people in cases, I don't believe so. Now, I could
Right.
be wrong. The future will tell us what the right answer was, but
Hmm.
um, that's sort of one of the trends I'm seeing. And also, Trump administration, I don't know if it went through, I just proposed some bill to make 401ks allowed to hold these privates
Oh,
and
right.
alternatives.
Right.
I think maybe in like August of
Which may
last
or may
year.
not be in the best interest of investors. Yeah.
Vast majority of people, I think it's not. I think
Right.
a lot of
Right.
people with 401ks or any sort of employer plan already don't fully understand the
Right.
relatively basic
A
suite of
target date
stocks and
fund. Right.
bonds.
Yeah.
Exactly, yeah. Let alone get into private credit where you're investing in who knows what,
Hmm.
with redemption terms and fees that are, hard to decipher. And
For
anyway,
sure. Yeah.
rushing into Roth conversions.
Yeah.
What are you
So
seeing with
so
that?
rushing into Roth conversions actually like it makes sense why everybody got so excited. There's actually two sides of Roth conversions. One side is excitement about future long-term tax-free growth, but actually the rush into Roth conversion is actually based on the other side of the coin, which is fear-based, which is
Mm,
this is your last chance to do Roth conversions with these low tax rates. So this was really happening with this anticipated sunset of the Tax Cuts and Jobs Act. So at the end of 2025, or really before 4th of July 2025, everybody was like, okay, actually, especially in 2024, people were like,
yeah,
convert while you can, like, like tax rates are going to double or whatever's going to happen. So there was not just an excitement about tax-free growth, but it was really a fear of like, this is my last chance to pay low taxes. I'm going to get crushed in taxes in retirement if I don't convert, especially if I don't convert now. And I think the big limited belief or misconception is this idea that that it's Roth now or never. Like I have to do a Roth conversion or a Roth contribution now, or I'll never get a chance to have Roth money in the future. Where in reality, like we know this and educate on this, is that it's now, later, or never. We just discussed the opportunity of doing them later, which is saying, hey, make traditional contributions, convert those to Roth later, when hopefully you're going to lower, pay tax when you pay less tax is a big theme of the book that we had. But I think this rush to do Roth conversions, it was really set around the anticipation of that sunset, with legislation.
mm,
And now that it's been extended and actually even better opportunities for, moving forward, I think that the rush toward Roth conversions is still popular, and we haven't really, rethought why we're rushing into it. I would say even if the legislation hadn't happened, or if it did sunset, I think that a lot of retirees or just investors, period, a lot are rushing into conversions, saying, hey, the best time to do a Roth conversion, right, is when you have lower income sources.
yeah,
So rather than getting caught up in what the tax rates are today and what the tax rates could be in the future, I say, well, I really care about what are my sources of taxable income today and what do I anticipate my future taxable sources of income to be. Because really, the Roth conversion math really isn't based on the tax rates. It's based on your taxable
correct.
income, therefore, which tax rates will actually apply to you. So even if tax rates go to 40%, will I actually be in a place in retirement, for example, when I'll even get up to the 10, 12, 22, 24, et cetera? So I even see people who retire, spend more money in retirement than they did while working, with sometimes even like half the effective average tax rate than they did while working. So I
Yeah.
think, certainly you wrote the book all about this stuff, but I think the rush to Roth conversions needs to like kind of slow your roll, step back, understand what is a Roth conversion actually achieving, not just today, but like looking I don't get too caught up in like, 30-year projections, but directionally you need to understand, hey, does a Roth conversion relatively make sense based on where I'm moving with my future income?
That's it. Directionality is the best we can do because no one knows what's going to happen to tax legislation in 5 years, let alone 30.
Right.
And people can very well live 30 years in retirement. Um, I couple comments. You mentioned the words killed in taxes or crushed in taxes. I dislike those. I think
Mhm.
that's hyperbole, sort of clickbait, people trying to sell you something. Not to say taxes won't potentially be high for someone, but when I see the
Mhm.
words crushed and killed, and it's like, oh man, really? Um, I don't know. Now, I guess there are some extreme examples where, getting a little off topic here, but like the people that owned the place my father used to work at before he retired, it was a plumbing wholesale business that's been around like
Mhm.
50 years, more than that, I think. They sold to a larger publicly traded place. Two people ended up owning it by the time it was sold, and they owned 100% of the shares, or at least I believe they did. And I think it sold for $130 million. Now, I don't know what the people's basis was, their tax
Contributions
base.
or yeah. Right.
Yeah, but let's just assume the vast majority of that 130 was taxable gain, and it was split two ways. So what's that? 65 million
Mhm.
of capital gain to each person. The owners lived in New Jersey. One, if not both, moved to Florida when they knew this sale was
I
ultimately going to happen.
love it.
Now that's an example of like the tax savings on that move to Florida
Right.
are
Paid for the
huge.
move to Florida. Yeah.
Yeah, yeah,
Right.
because on let's just assume $65 million is your gain. I don't even know what New Jersey taxes at that rate. Let's assume it's probably upwards of 10%. So they avoided, let's call it $6 million of New Jersey state income tax by moving. They couldn't avoid the federal tax, but by moving to Florida, they saved $6 million compared to what the others would have had to pay to New Jersey. That's a big savings. Now, I don't want to say
Right.
they
Return
didn't
on
get killed in
hassle is
taxes.
high. Yeah. Right.
Correct. Yeah. Now, if family reasons and other reasons support you being able to move from New Jersey to Florida in this case, like cool, go for it. For the average folk, and I'm not saying the people we work with and talk to are average. I mean, there's a lot of extraordinary people here, but we're not talking about tens of millions of dollars of income or potential tax liabilities, right? We're talking about uh, a couple $1 million of IRA money we're converting, lifetime's
Mhm.
tax impact and savings on that. I don't know, a few $100,000 maybe, all said
Right.
and done over 30 years.
Mhm.
So to say you're going to get crushed or killed in taxes if you don't convert,
Yeah.
it, first of all, that's a very subjective term. Secondly, we don't
Yeah.
know that's going to play out. So I don't know. Those things rub me the wrong way.
Yeah.
Um, I had another thought that I was about to go on, but then I got too heated about this crushed and killed thing.
Well, here I will tell you that, yeah, I think I've never seen Roth conversions even directionally like make or break a retirement plan,
Correct.
right? So
Yeah.
like I say Roth conversions can be beneficial, but are they needed? I would say no. I would say Roth conversions, like if yeah, please, send me hate mail or send me maybe send me a scenario where a Roth conversion actually like leads somebody to be able to retire successfully versus not. I've never seen an example where a Roth conversion really helped with somebody else, like somebody's own sufficiency. It's mostly been for like legacy or like just saving taxes over like, multiple decades.
Yeah. Great point. It can make a good plan a little bit
Hmm.
better, all said and done. It can make a bad plan maybe a little less bad, but it
Right.
is not going to directionally change. Does this plan work? Yes or no? Is this a good plan? Yes or no? This is all just an exercise in optimization
Right.
to expand how much legacy you might leave behind. It is not going to take someone who can't afford to retire and all of a sudden, oh, I did a Roth conversion. I can retire tomorrow. Like, no, it
That's
doesn't
right.
work like that. I know what I was going to say. Going back to like the fear mongering clickbait thing, you mentioned it's not just the federal tax rate or tax brackets, generically speaking, that matter. It's your personal taxable income and effective tax rate that you're paying. And what I dislike is people, and these are often people intentionally trying to mislead. They'll say, look at the history of the top federal tax bracket. It was 90
Right.
something percent after World War
Right.
II.
It's
The top
and it
tax
could come
bracket now is
back. Yeah.
37. Exactly. It
Right.
has to go up. It could go up as high as 90%. Therefore, and usually it's someone selling insurance, like, therefore, go buy this index universal life insurance policy or something to get ahead of that, try to save yourself that taxes. That's just fear-based selling. The reality,
Mhm.
like you said, yes, maybe the top federal tax bracket does go up to 90 something percent. Even if it
Who's
does,
going to
that's
be
not going
paying
to,
it?
right, exactly.
Right.
That's not going to impact 99% of the people listening to this show.
Right.
Um,
Yeah.
and even if it doesn't, let's just assume taxes go up just marginally, which I assume they will. I assume the brackets will
Hmm.
creep up a little bit going forward. If you're a high earner now making $500,000 a year in wages, you're going to retire in 2 years. all else equal, your income's dropping $500,000. It almost doesn't matter how much retirement assets and IRA money you have. Now is not the time to convert if you know your income's dropping $500,000 in 2 years. Even if federal tax rates go up, you personally will be in a lower tax environment in 2 years than you are now. So tune off the noise trying to sell you on taxes are going to skyrocket. Well, maybe nationally, but are your taxes going to skyrocket? Maybe not. They might actually go down. So
100%. And something related to this that often comes up in the Facebook group and other places is that like people get concerned about the estate and gift tax exemptions federally going down, or and like as you know, again, like even if they cut in half, like still like 99% of Americans would still not be affected. And same thing with gift taxes. We have to tell people over and over again that's it's really a filing it's really a filing requirement, not actually paying gift taxes when you give over whatever the number is to each kid, each child moving forward. So just anytime you hear tax rates are going up, just come back to the reality of your own situation. What is my future, my current and future, at least anticipated income sources look like, and apply those rates directionally. Some financial planning software can help you directionally, but also I've also seen the issue of people using software assuming that like those 30 years of assumptions are correct, right? In reality, they're just like, the best guess we can make. And there are probably some inputs that we haven't quite really considered in much detail, including a lot of financial advisors. We often plug a lot of stuff into these softwares without understanding the mechanics of how this stuff is actually calculated. So just, measure twice, be careful, and don't overdo it if you have a chance.
I like how you're working the term "measure twice" into this conversation. You've
Oh,
done
sure,
it a few
sure.
times.
Yeah,
Very nice. Nice touch. Yeah. For those of you watching a video, Cody's got the big "measure twice" money sign behind him. Well played.
Well, you're a carpenter too, so you understand that phrase very well.
Oh yeah, measure twice, cut once. Exactly. Yep. I've unfortunately made the mistake of measuring once and having to cut twice. The piece I ruined, and then the new piece I had to buy to cut and get right.
I love it.
All right. Health savings accounts and using HSA money after Medicare. So after you're 65 and signed up for Medicare.
Yeah. So the biggest thing about HSAs, health savings accounts, is again, people talk about like they're like the best account out there because you get a deduction on the way in. They grow tax deferred, and then you get tax-free distributions for qualified medical expenses. But one of the bad things about HSAs is how they're inherited by a non-spouse. If they're inherited by your spouse, it just effectively becomes theirs to keep using. But if it's inherited by a non-spouse, it's all taxable as a distribution within 1 year, right? So, just keeping that in mind, typically, kind of a rule of thumb I use is once Medicare starts, you should know that a health savings account can, yes, reimburse your past unreimbursed. Actually, what's called, Sean Mullaney, my co-author, calls it previously unreimbursed qualified medical expenses, PUCME, for short. There you go.
Nice.
Yeah, PUCME, PUQME. So
I like that.
Not only can you reimburse your past medical unreimbursed medical expenses going back to when you first established a health savings account, but also Medicare, Medicare Part B and D, original Medicare A, B, D, is reimbursable as a qualified medical expense. Keep in mind that Medigap supplemental plans, those premiums are not HSA eligible, but effectively, most clients I work with, once they get to 65 or once they start Medicare coverage, we start reimbursing those premiums from the HSA. I'll also say that I used to think of an HSA and a Roth IRA as like the last spend assets. I think that's generally true. I would say that I would put the HSA before the Roth IRA in order of operations.
Right. Just
But
so you
I
don't
also
leave it
use
too much behind.
Exactly. But I also use the HSA, assuming it's a qualified distribution, tactically, sometimes even in early retirement of like, hey, like, we're gonna like, oh, we have a big expense, but if like, if we had to, we might have to do some, if we realized more gain or had to take more money out of a retirement account, it would boost us into a next bracket or something like that. Sometimes I use the HSA to tactically kind of take money out tax-free during those like kind of those bumpy years. So I think on average, I tell people that once you start Medicare, I'd probably start unwinding an HSA. Not advice for anybody on the call, but I think generally that's a pretty good rule of thumb. Some people say, hey, well, I might need that for long-term care. And ironically, there's a lot of studies that show, hey, like a traditional IRA, taking money out of a traditional IRA might be better because you might be able to itemize those deductions when you have long-term care expenses. So I would just say, typically you don't want to die with an HSA as a single, without a spouse.
Yeah,
But with that said, again, if I inherited an HSA that's all taxable in 1 year, like I wouldn't be too upset. It could
exactly.
be more optimized, but it's still money at the end of the day.
Yeah, I agree. I've thought about this a lot, and I don't have a great answer. I've had clients ask, when should I start tapping my HSA? I explain the same thing. If you're married, you can leave it to your spouse after you pass, and it functionally
Mhm.
becomes their HSA and looks and acts the same. If you're single or you're widowed, and you're the last survivor, when you die, unless you leave it to charity, because charities don't pay tax anyway, you leave it to
Mhm.
anyone else besides the charity, they're going to have to pay tax on the full distribution. It's either in the year you die or within a year after, something like that. Like
Mhm.
soon
Yeah.
thereafter, it's fully taxable to
Right.
them. The only difference is or little exception is, what was it? Was it like
Or
health?
yeah, you mean paying your pre-death expenses, your like
Yeah,
medical expenses
but there's
afterward.
like a limit to how far back you can go. It's your pre-death expenses or something that the estate didn't already pay out. I don't know. I'm going to say something wrong, so let's not
Oh,
go
sure,
there.
sure.
But
It's all good.
let's just assume when you inherit it, you can't use it again unless you're a spouse. Once you die, it ceases to become an HSA. Now it's just a fully
Right,
taxable distribution.
right.
Um, so with that in mind, I usually tell people, assuming you're healthy-ish and you expect for now average life
Hmm.
expectancy, start spending it in your 70s because it is so tax
Hmm.
advantaged. Try to let it sit and build up. But again, not wanting to
But you're
die
not
with
going to
much,
get
if
you're not going
any.
to get like you're not going to get 30 more years out of it most
No,
likely.
not massive growth at that point.
Right.
But I'm like, I don't know, in your 70s, we'll start systematically taking it out from Medicare or large
Yeah.
expenses like you need new hearing aids or something. 65, your approach makes sense as well.
Mm.
The
Well,
point
I
is
will say
you
that.
want to leave it as long as you can, but also not leave any behind. So it's
Right.
kind of hard
So
to,
yeah, maybe a good rule of thumb is like, hey, like, keep it going while you're married. But once you're either a surviving spouse or a single taxpayer, I would start pulling it at 65 when Medicare
yeah,
starts. So kind of again, none of this is perfect, perfect
yeah,
planning, but just a general rule of thumb that I would feel comfortable telling, anybody.
yeah, makes sense. And I also like using it tactically. I had this same conversation with someone about a month or two ago, trying to get some additional cash, trying to tightly manage income for IRMA reasons, stay within a certain bracket. And basically all the money's in traditional IRA, some amounts in bank, and then HSA. There's really negligible Roth assets. And so the thought was, okay, well, you've had this HSA for whatever, 10 years.
Hmm.
You've had a lot of unreimbursed expenses. You can retroactively take money out now, reimburse yourself for those expenses you previously paid and were not reimbursed or covered by insurance prior, as long as those expenses occurred after the HSA was started. Um, so this could be a great way to free up whatever, $10,000, $20,000 of cash, doesn't get included in your gross income, again, assuming you're using it to reimburse qualified expenses. So
Hmm.
that could be a great source of cash if you're trying to tactically manage income limits, like you were saying before.
Yeah. And the
So
HSA, by the way, assuming you don't have a spousal beneficiary, it's also actually the best account to give to charity, even better than a traditional IRA or something like that that would have like a 10-year distribution schedule. So like again, you probably wouldn't want to set the charity as the primary beneficiary if you're still married because you want your
yeah.
spouse to be able to use it. But I think setting a charity as your contingent beneficiary on your HSA is a pretty good tactic, assuming you were going to give it to charity anyway.
And just curious, I haven't heard that. Why would HSA be better than traditional IRA if you're leaving it
So
through charity?
right, so they're the same in terms of giving to the charity, but if they're given to a person instead, the HSA is all taxable in 1 year, whereas the traditional has 10 years to
Got it.
be
Got it. Okay.
distributed.
So meaning if you have various accounts, you're going to leave to mostly
Right,
people, but also a
right.
charity. Got
Yeah,
it. Okay. Yeah.
yeah,
Yeah.
if you're going to give it to charity and part of your estate anyway, go
Yeah.
ahead and start by the HSA like being the priority there.
Got it. Yeah, I agree. That makes sense then. Okay, tech stocks. What's up
Mhm.
with tech stocks? Should we be worried? And how much
Yeah,
they've run
so
up last year and the year before and the year before?
yeah, I'm probably gonna have like the most like boring reaction to this, but like I tried not to have an opinion about investments. Like I try to be pretty like objective, like globally allocated, like low cost passive index funds is how I invest. I know that we can look at tech just like other sectors in the past. I know that all these like ratios like PE and Schiller and all these things are like the highest they've ever been. But again, like we also live in a different environment than we've ever been. I think most people can kind of assume that. I guess my only big thought here is that even though we see technology as a sector, like technology, I'm actually surprised technology is still a sector because, as you know, like technology is now ingrained
Laced throughout
in like
everything.
yeah, in like all 11 sectors of the of the market. So I'm not concerned. With that said, I think if you are concerned about tech exposure or like cap weighted exposure, I personally I'm not into equal cap where you kind of spread the capitalization across, like you effectively you over you overvaluate a lot of companies by doing that. Like you
Yeah.
have an opinion effectively by doing equal versus weighted. I guess you have to have an opinion to invest to begin with. But I would say that if you're worried about tech exposure, for example, I would actually step back and say, hey, you're actually it's less about the tech exposure than just understanding, hey, like, let's step back to the financial plan, right? So, I mean, I would just say focus on the plan, focus on you, not the market for a minute, and say, hey, I always say give every dollar a job and a use by date. So if you look at your portfolio, say one good rule of thumb that I use for myself is how much money do I plan to take out of my portfolio over the next 7 years? And personally, I don't like those 7 years of money to be in equity to begin with, regardless of whether it's dividend paying stocks or gold or real estate, whatever. I typically like, from a risk capacity standpoint, I like to keep a certain amount of fixed income in my portfolio. And then determining how much equity or how, like, where you put that equity is actually mostly a risk tolerance, more of a subjective opinion than it is an objective fact. So, yeah,
Mm.
what's your take on tech and if you're thinking differently about this sector than others?
I align with you. My investment thoughts and process are super simple. I came up with the portfolio allocations and fund selection, which is all just, especially on the stock side, a few low cost index funds that across the few I use capture the entirety of the publicly traded global investable universe without any overlap in underlying holdings across funds. The decision making, the speculation, if you will, of deciding how much to put into each one was a decision.
Mhm.
So, you can say I inherently overweighted or underweighted US versus international or large cap versus small
Right,
cap by choosing the allocations that I did. And I won't
right.
share here what they are because I don't want people to
Sure,
view
sure.
this as a recommendation or investing advice. Um, but I'm not worried. Like I've written about this, I talked about this before. The S&P 500, the 500 largest companies traded on US stock exchanges, is dominated by the top seven,
Mhm.
8, 9 companies who make up collectively like 40% of the index. That's huge. Is that a bad thing? It just is. It's a function of those
Mm,
companies are
right.
valued and viewed that much more than the 490 other companies, large companies in the US. So the more you start to stray from that, like you said, if you invest in an S&P 500 equal weight fund where each of the 500 stocks has an equal proportion, and there's a fund that does that, I don't know the name of it, and this is investment advice again,
Yep.
you can do that, but you're inherently saying, I'm going to take a position different than what the actual market is and what the market said these companies should be worth. Will you be right or you be wrong, or better or worse? I don't know. Only time will tell. But point is, I think especially on the stock side, this stuff isn't worth worrying about. Pick allocations that you understand, that are low cost, that were put together with some sort of semblance of
Mm,
purpose or intention. Um, Make sure you're not overexposed, for your risk tolerance or risk capacity. You're not taking more stock exposure than you're willing or able or comfortable or financially able to take. After that, just stop watching the news, turn off the
yep.
noise. Don't listen to us talk about tech stocks.
Right.
Rebalance your account whenever necessary based on whatever parameters you set for when you should rebalance your account.
Mhm.
But otherwise, whether techs are up or down, whether small caps up or down, whether
Yep.
US is up or down versus international, it's all just noise. Tune it out.
Well, and a little objective, some percentages here. So, by the way, people are saying the same thing back in July of 2020, right? So, think about like mid 2020, people are talking about tech being overhyped, especially as it went, the COVID
Yeah,
swoosh
yeah.
as it did, right? But I was actually meeting with a client today and, with concerns about tech and, being, a big part of the S&P 500. And I actually looked at, so the total stock market index, if it were to drop, again, I just took one of those index funds, if it were to drop by 50% in price, like overnight, it would be back to the price it was July 2020 when people were saying the exact same thing we are today about
Yeah.
tech exposure. FANG was a big deal, FANG stock, and then it changed letters around FAME and, it changed all its letters. But again, this is one of those things where like, you hear like you have to time it twice, right? So
Yeah.
like, if you change your allocation based on, what you think, what you feel, like, you need a process in place for how you're going to change your process moving forward. So effectively, if you don't have a written process, you don't really have really a plan. It's more of a kind of a I think Rick Ferry talks about like the best asset allocation is one that you can actually stick with, right? So really step back,
exactly.
create a financial plan. The basic asset allocation between equities and fixed income, right? Stocks, bonds, cash, like that's the biggest driver of returns, regardless of which sectors you go into over long periods. So I would step back, set your asset allocation based on when you expect to actually spend money from your portfolio, your risk need, risk capacity, risk tolerance, right? But I just personally, I don't play around with having opinions about which sectors are going to go up or down or timing the market.
Me neither. I also agree. I have to look in context of, I'm almost sort of hoping the U.S. stock market drops some this year just to cool off. 10% would be nothing. Like that's long overdue. 20% feels like a lot, but who knows? Maybe that's well within reason and overdue.
Well, a 20% drop would be back to July 2024 prices.
That's what I was going to say. Even if it does, look at where it came from. Exactly.
Right.
Now, I'm sensitive to use that argument to too much of an extreme.
Right.
Because if you look back far enough, like if the stock market dropped 95%, you're like, oh, it's only back to where it was, 1930. Like, you can only go so far with that argument. But
the dollar amount is what matters, right? And that's where it comes back to, hey, if you can't weather from, especially even objectively, for your portfolio to drop by 50%, at least temporarily, correct, like then, really step back to the plan to create your own buffers, not necessarily using a product to do that, but just like setting your own boundaries around how your money's allocated for stability, income, diversification, et cetera.
Exactly. That's interesting. So I guess you have the data in front of you, or a graph in front of you. If the market drops 20% now, January 2026, it takes it back to where it was July of 2024, did you say?
Yeah, July 2024, 30% back to December 2023, 40% January 2021, and 50% back to July of 2020, which is actually after the recovery post-COVID.
Yeah. So, these aren't trivial declines. You're setting yourself back 3, 4, 5 years, which are big. Right. If you invested all the while,
50%,
then, 50% is huge. That's
like people would be, there would be more going on than just the stock market if everything fell by 50%. And that's the entire U.S. market is dropping by 50%, which historically, like over a short period, like doesn't, has happened, but very, very, very rarely in different circumstances.
That was like a global financial crisis, 08, 09, which was, I'm not exaggerating. I was working directly in the pipes and plumbing of the U.S. financial system. That was almost like the collapse of the modern financial system as we know it. So that's how bad that was. And that was a 50, maybe 60% peak to trough decline of global stock markets, at least. U.S. may have been slightly less bad, but.
I would say like anybody listening to this who's been investing for decades, most likely your portfolio is double than it was 5 years ago. So like, I think a lot of retirees I'm working with, when they first worked with me 5 years ago, they felt like, okay, like I feel like I have enough to retire. Now they feel like they have more than enough. And now they're like, hey, again, going back to their plan, they say, hey, maybe I'll take some chips off the table because I don't actually need my portfolio to double again for me to maintain my maintain my lifestyle in retirement.
It's a cheesy saying, but I think it applies rather well in a lot of cases. If you already won the game, why keep playing? Right. You don't need a 90% stock valuation. If you're already at your target number that works for your projected, expenses and lifestyle for the next 30 years, if you're going to lose sleep over seeing your portfolio whip around a lot, even if objectively you're still fine financially, why keep playing? Like dial it back. You're not desperate to fight for that growth to finance the rest of your life because you're already there. So
and it's your portfolio. Like if anybody else tells you you're crazy by keeping that much bonds or that much cash, like it's it's your life, right? So don't invest on somebody based on somebody else's opinion about what you do.
Correct.
Which again, that goes way beyond money, but relationship. Right, exactly.
Another thing we kicked around potentially talking about is RMD timing. RMDs, always a fun topic.
Yeah, so I think my bias, maybe because I'm a financial advisor, is that like I try to do most year-end tax planning before Thanksgiving dinner, right? Like I think a lot of people wait until like it's too late and they're too busy. They wait until December and like when they're thinking about, travel and family visits and all these things. And I'd prefer to get your RMD done like, before Thanksgiving. And that's actually like we talked about earlier, right? Like I would actually prefer typically to do your RMD later because that might also be maybe you not only qualified charitable distributions if you're 70 and a half or older, giving to charity. But also we might do, that might be the good time that you kind of know where your tax liability sits. And maybe that's the time you maybe a big part of your RMD goes to taxes, maybe even like, 99% of it, depending on which custodian allows you to put it that high, right? So I think rule of thumb for me is like before Thanksgiving, like mid-November is my favorite time to do that kind of stuff. With that said, like, if you need the money, right? If you need the money from your RMD, like if you're taking money out of your portfolio anyway, you're probably going to hit your RMD pretty quickly. But yeah, what's your take on like the timing of RMDs personally?
I work it into each person's plan, and like you said, sometimes we'll use some or all of it to withhold for taxes, in which case we may wait till later in the year to do it. If they need the money, obviously we'll go ahead and do it sooner rather than
Ooh,
later.
yeah, I have a note
Um,
too.
I don't remember why, but in the tax planning certified professional curriculum that I went through a few months ago, I do remember Jeff Levine, who's one of the best and brightest in the tax planning game, said the ideal optimized answer is to take RMDs ASAP, like
Because of the
full stop.
growth.
Now, I think it was partly growth. Like, yeah, if it's all in a pre-tax account, assuming your account's going to grow more times than not any given year,
Right.
why do you want more money in there to grow just to be further taxable in the future? Take it out now. If you
If
don't
you're
need
not
it, turn
spending
around and
it, yeah,
reinvest it. Exactly. You're not
right, right,
spending it. Reinvest it
right.
into a bank account, a brokerage account, something else where you're not going to be taxed as heavily on that growth going forward. So yeah, that makes sense. Another thing was if you are older, um, and you pass during that year, you want to ideally have your
Right.
RMD taken so your
Yeah, that'd be
heirs
nice.
aren't stuffed with having to take it for you in that year.
Right. Yeah.
There's something else, I don't remember
There,
why.
well,
So
another one too is that like this is I wouldn't say rare, but like less likely. But if you are doing Roth conversions, you definitely want to take your RMD before you do
oh
a
yeah,
conversion.
yeah,
So I think that, again, like kind of generally, like, make sure you take it. But yeah, another thing is, this kind of comes into like Roth conversion timing. Again, RMD timing and Roth conversion timing, usually, they might not, the RMDs are kind of after the golden years for Roth
yeah,
conversions on average. But I would say that, yeah, Roth conversions, the timing of Roth conversions, I don't, again, I don't like to time the market based on conversions, but sometimes people say, hey, the market just went, 20% below all-time high. Like, is this a good time? And but I come back to like I really want to set myself up for being able to buffer my taxes at the end of the year. I don't like to like just have again you don't want to do all your tax planning in Q1 and then Q3 Q3 Q4 something big happens to your
yeah.
life, right, financially. Not that it would definitely crush your plan, but tax optimization I like to wait till the end of the year. But if an RMD has to happen, it's not like you're going to be really hurt that much by taking it in July,
Correct.
January.
Yeah.
Just yeah, make sure you take it.
I like that. There's a very, very important point about you can't do conversions until you meet your RMD. 100% accurate. Like you flat out can't. Now the custodian might let you, and if they
And
do,
you
that's
can't
a big
convert your
hassle to
RMD
unwind.
either. Yeah.
No, if you have $1 million IRA, your RMD, you turn 73 this year, your RMD is like 38,000 bucks, and you want to do conversions, you cannot do conversions until you first fully distribute, like taxable distribution, that 38 grand or whatever your actual RMD amount is. Now you can do some of that, some or all of that through qualified charitable distributions, QCDs, that satisfies your RMD. So some combination of QCDs and or outright distributions, you have to do 38 grand of that first before, if you still want to
Right.
convert, you have to convert after that 38 is distributed or
Yeah.
QCD'd. Now,
Yeah.
where this can get complicated is not clients, but other folks I've talked to, they have like rather large annuities with
Mm.
IRA money, and the annuities pay every month, and they're paid such that throughout the course of the year, the annuities will satisfy their RMD with
Mm.
some smaller distributions. Now, that means you're basically stuck. Like if you want to do a conversion, your
Oh,
RMD is
wow.
not going to get met till December, let's say, because of that last
Yeah.
month's annuity payment. You want to do a conversion, well, you can't. You're going to have to front load and take more distributions early just to meet your RMD earlier in the year to then do conversions. But then you're still going to have these annuity payments showing up every month. And you don't want to turn those off. It'd be stupid, like giving away money. Not giving
Yeah.
away, but if you can even turn it off, depending on the type of annuity it is.
Yeah,
So anyway, so like it could get
yeah.
complicated, but
Yeah. We have a final bonus on RMD timing. If you wait to take your first RMD until April 1st of the next year, like you'd want to take that one early. But I think most clients I work with, they prefer to take one RMD per year, unless
yeah.
there's some really unique situation where like the second year they're going to have a lot less income of their, yeah, that first RMD, make sure you take that by, what is it, April of the following year.
Yeah, which is an interesting point tying into Roth conversions. So I had this situation come up. You turn 73 this year, 2026. This is the first year you have to start taking RMDs. Like Cody just said, first year RMD and first year only, you can actually defer until April 1st of the next year, so 2027 in this case. However, just because you're not required to actually distribute that RMD this year, you still can't do Roth conversions this year until you meet that RMD.
Because it's an RMD for that year.
Correct. Because it's attributable to this year. Yeah.
I think I saw that in the Facebook group. Yeah.
Yep. So if you want to do conversions this year, you can't defer your first year RMD. You have to actually take the RMD this year. Only then can you do conversions above and beyond that for this year. So that's a little gotcha to watch out for too.
Yeah. Don't you? I love it. All these wrinkles that we care about that people never touch.
People never touch it until they somehow stumble across it. Maybe after the fact, unfortunately. It's like, this is so obscure, esoteric. The average person is never going to know about this. They're never taught this. Hopefully through forums like this podcast, like the Facebook group, that still doesn't capture most of the world, but for the people who are in it, they learn something. But I bet there's so many people who make these mistakes simply because these distribution rules and tax rules are so goofily complicated that it's like, how are people supposed to realistically know these things? They're almost set up to not know them and fail.
Well, Andy, do you have a room for one more crazy situation that I just recently thought about?
I love crazy situations. Yes.
All right. So imagine that somebody is able to itemize their deductions. Okay. They're able to itemize their deductions on Schedule A, and their itemized deductions exceed their standard deduction by, let's say, $10. Okay. But their itemized deductions are partially met. They're able to itemize partially because of medical expenses that are deductible.
Ooh.
Right. What's interesting though is, so it would technically be better, right, to itemize their deductions because it's $10 more than their standard. But if they itemize their medical expenses, like let's say they have $30,000 of medical expenses, that helps them itemize by $10. The full 30,000, based on my understanding of the full 30,000, would not be able to be reimbursed tax-free from an HSA because it's being used to deduct. So even though it's not, even though like, let's say only like $10 of that 30,000 is actually part of the deductible part, because they're including it in that calculation, like they can't reimburse themselves. So that's one of those like funky things. Like if you're able to itemize because of medical expenses, just pause and say, hey, like, do I have HSA money that I'd like to reimburse tax-free, but don't have the medical expenses for? And, again, return on hassle is part of that too, but that's just one of those fast, like, just because you don't deduct that portion, you've just now made those void for being able to reimburse tax-free in the future.
That's it. Yeah. There's the concept of you can't double dip tax benefits. In this case, you'd be double dipping by getting an itemizable deduction on the expenses. And if you were to reimburse yourself for those expenses from your HSA, you effectively paid for those expenses with non-taxable money. So you can't get a deduction of non-taxable money. Even if that part was actually part of the 7.5% AGI that you had to fill up before they could even be deductible, which is just fascinating. Okay, this is one of those like beyond the scope things, but it's just a lot of fun. So great questions in the Facebook group all the time. Definitely. All right. Final topic I wanted to kick around was, retirement spending anxiety.
Yeah.
What you mean by that?
Yeah. So retirement spending anxiety is, I guess a big part of it is kind of generationally. I know we could definitely talk for hours about this, but generationally going from, Great Depression, what they taught their kids, hoarding has become very popular, not just in tangible items, but, like I can even speak for, my own family, people were taught by their parents, hey, like you never know when you're going to need this, right? People who, Great Depression parents. So there was a lot of hoarding of things. Now, especially, I think that those messages are continuing to go down the family tree, but there's a lot of hoarding around money, especially within like the DIY communities. I would say these are primarily what I call high risk capacity, which means they actually could invest probably 100% of their money in equity and still meet their objectives because they take such a low distribution rate. Let's say, they're only taking out maybe 2% of their distribution of their portfolio every year, right? So they have a high risk capacity, but they have a low risk tolerance. Yes. Which, when you have somebody with a high risk capacity, low risk tolerance, these are the types of people that typically join these like optimization DIY groups, but they also have this anxiety around kind of this hoarding idea of, well, like, all the numbers tell me that I can spend more money, but if I do end up spending that money, but what if I need it in the future, right? So like, I think there's I think ultimately a lot of the spending anxiety, actually from our community specifically, it's actually like it's a distrust of the numbers, right? So it's really that, like, regardless of the numbers or who tells them the numbers, they just can't trust it. They go, well, it's the anybody who says this time it's different. You've heard
Yeah.
that quote a lot, right? So I just think that for those who are listening to this and say, like, I'm that type of person where, like, each time there's an event, it feels different. Like, I get really close, I hoard, even though I, like, objectively know that I could spend more money. I actually think that the biggest solution for that actually isn't, I think financial planning does help, but I actually think that like a mental health professional, it'd actually be very useful, because a lot of these anxieties around spending are actually not just money related. They're related to relationships and deeper beliefs that we have, just systems that were unspoken, or maybe spoken, unspoken, or unwritten rules that we've kind of heard growing up, that we haven't identified that, hey, like, the reason that I feel bad or icky, like, selling investments to enhance my lifestyle, is because of something that happened decades ago, from people related to people who aren't even around anymore. I know this is a very deep topic, but I do think that I would tell anybody, like, whether you're retired or not, I think having a financial professional and a mental health professional at every time of your life is probably a good idea. So physical, mental, spiritual, relational, and financial wellness, like, you can find mentors or professionals in all those areas. So yeah, I don't think that anxiety, this maybe goes against maybe like the RISA profile or like Wade Fowles research. Like, I actually don't think that a product, that buying a certain investment product or a financial product will actually solve spending anxiety. Like, I think it can help on the edges, but it actually won't solve the underlying anxiety that probably goes beyond money.
Same. I've experienced that, and I'm so ill-equipped to really, like you said, I think people need truly a therapist to work with money issues and family dynamics and histories and money scripts that sort of cemented their views and beliefs and restrictions and relationships with money. The best I can do, and I'm not the most empathetic, soft, touchy-feely type of person, but
New Jersey versus Texas.
yeah, right. I can show them sort of objectively and try to explain in very as warm of language as I can use why this is okay, whether it's back of the envelope, rough cut calculations, whether it's Monte Carlo, which is, complex and just ultimately a big educated guess, other sort of rules of thumb. If I can triangulate all these different data points, be like, look, there's no reason to think this objectively doesn't work. I've kind of done all I can do. There's only so many times I can be like, no, you're going to be fine. Like, I get it. You're anxious about spending money, but just go ahead and spend. It's not that simple. And I get that. So I don't know. I wish I was better at that. I wish I know I'm part therapist, even though professionally I'm not. I know practically that does come up. I see that a lot with a lot of my clients, and I wish I was better at helping them get more comfortable with spending through whatever the triggers or ways are to get them to get comfortable.
That's right. Yeah. So I just, the quote here I just wrote down, and this idea is, you can't underspend your fear. I think people say, like, if they have this idea, if only I spent only 1% of my portfolio, or if only I just lived off the dividends, or if all these, like, tactics that we try to optimize to try to, like, spend less or save more in taxes, like, isn't actually going to solve the underlying issues. I wouldn't even call it an issue, but like a challenge and an opportunity. And I think that's really where I do a lot of leaning into values driven spending, that if I tell a client, hey, you could actually spend 4 times as much as you do, right, objectively, I really need to lean into ways that they're not just going to go buy boats and TVs and stuff that they don't, enjoy or value. It's saying, hey, you're already taking a trip with your family to the beach. How, like, maybe you could stay right on the water versus a few blocks from the water, right? Maybe you can enhance. Yeah. So I always think about, like, if you have permission objectively to, like, to spend more money or to give more money, there's only 4 people who are going to spend it, right? You, family and friends, the government, or your favorite charity. Like, if somebody's going to spend it, try to find ways to enhance what you already spend money on. So if you already like going on big trips, like, make them bigger, right? Or if you go on small trips, make them bigger. If you like flying across the world, maybe try business class, maybe not first class, but business class. Like, just start these, like, experiments and exercises of enhancing what you already value. And that'll feel a lot better than feeling like you have to spend money on, like, this, spending money on silly stuff that I don't value to begin with. Because anytime I tell somebody, hey, you can spend more money, they always say things like, I'm not the type of person to fly first class, or like that type of person mentality is really what is really solved through therapy, not through financial planning.
Great point. The only other thing I can add is I've seen with clients, the reluctance to spend typically eases up a little once they get into retirement and start taking that first upgraded business class
Mm,
trip seat. They get a little more comfortable, and then maybe that expands their
literally.
comfort zone a little bit. But
Yeah.
yeah, oh yeah, exactly. I went my very first managerial job. I was like 3 years out of college. I had this like
Mm,
supervisory role in a financial operations group, and they sent us to management training. Some of it was really good. A lot of it, I thought the one was a bit out there. There's a lot of like self-help stuff more so than like management skills. But one thing she said that really resonated, she drew a picture and like picture a circle. She said, this is your comfort zone. Everything you've ever done is inside this comfort zone.
mm,
Unless you intentionally step out and put a
hmm
dot outside that circle, you're never expanding your comfort zone. But guess what? Once you do plot a dot outside that circle, you now draw a new circle where the new circle
hmm
encompasses the old dots and the new dot.
Yeah.
So the
It's
only way
called,
to
it's,
expand your comfort
yeah.
zone is to actually, do stuff outside of it.
Yeah. So in therapy, they call that, progressive exposure. And that's
Okay.
also, that's called your window of tolerance, right? So yeah, like what you said is like the only way to, increase your tolerance is to like just do progressive exposure steps to expand your window so that by the, that if your window of tolerance becomes, much larger, what used to be scary now feels like just like a normal day,
Normal. Yeah.
right? Whether it's
And
financial or
spending's the same
otherwise.
way. Yeah.
Yeah,
Yeah,
for
exactly.
sure, for sure. So yeah, I want to go practice spending money on a nice dinner tonight, hopefully.
Do it. I
That
like
sounds
it.
great.
We're getting a new deck as we speak on our house,
Ooh,
and I
nice.
have to go to the bank after this to get, a fat slug of cash for the next deposit tomorrow. They hit the next
That's great.
milestone in building this deck. So
Oh, nice. It's always like
yeah.
exciting and like by the way, Andy, personally, like even if you had like, all the money in the world to do things, like would you still like feel that trepidation when you get a bill, like a big bill in the mail like that?
Um,
Or do you think about the
I
utility of what you're purchasing more so?
the latter. I mean, the deck's expensive. I won't say how much, but it was
Hmm.
a lot. It's not even a big deck, but it was a complete redo. We had to rip it down, take out the old
Oh, wow.
footings. We had to drill new holes, put
And
new
you didn't do
footings
it
in.
yourself. I'm surprised.
No, this is beyond my interest. This is a
Yeah.
lot of work. I don't want to do like the digging the holes in the footings. I'd like to build the deck
Oh, yeah.
itself,
Like
but even
putting in
still,
your own fence is a lot of work. Yeah.
exactly. Yeah, these guys will get the deck done in a matter of days, whereas me, it would take
Wow.
so many weekends and whatever. It's worth it for me to pay. Um, I'm okay with it. It's not a $200,000 deck. If it was, I'd be like, oh man, this is a lot. It's like a tenth of that, less than a tenth of that. So I'm got comfortable with the spending. I mean, yeah, it hurts to take $2,500 cash out of the bank to know this is
Right.
just one payment of many that we got to pay on this deck.
That's right.
But already did the analysis, got comfortable with it, made the decision. Yes, we're doing it, and came to terms with like this is what it costs. So
Home office deduction? No, that's more of an improvement than a repair, right? Yeah.
no, yeah, I mean it'll add to the basis of our house. So if when
Yeah,
we sell
right.
our house, it'll reduce the amount of potentially taxable gain by that much.
There you
So
go. We're
anyway,
always trying to just put salt tax planning in everything, but hey,
correct.
Andy, this
Yeah.
has been fun. This has been great.
Yeah, this is awesome. Thank you for coming. And these are great topics. I'm confident everyone listening will get a lot out of it. Um, Again, especially since people know you if they've been around the retirement planning education world, especially the Facebook group before. So you are a welcome face and voice to the crowd here. So thank you, Cody.
Appreciate you.
All right, that's it, everyone. Thank you as always for listening, and we will see you next time.